All right, thank you, Mario, and I appreciate your hospitality. And again, I wish we could do this in person. I would love to be there, but we'll make do now. So, as Mario said, the title is kind of a mouthful. So, I guess the goal should be by the time I'm done presenting, if you understand what the title means, then I think I've made some kind of progress. So, let me start with a little bit of empirical motivation. So, the economy has, up until the great financial crisis, our economy here in the US was experiencing what we refer to as the great moderation. And then, because of the recession following a lot of the stimulative policies, reserves and credit overall have pretty much exploded. And I kind of nicknamed this period the Great Reservation following the great financial crisis. So the policies that the central banks have run, basically like conventional policies, have been kind of uprooted a little bit because there's a little bit of a policy dichotomy here where we kind of have to ensure there's adequate credit and reserves in the system following these unconventional policies, but at the same time, we're supposed to try to provide some kind of stabilization policy. So there's been a bit of a revisitation of an older literature, kind of, I think, started originally by Poole back in 1968 with respect to the paper of stochastic reserve management or reserve management in a stochastic, banking environment. So this is kind of been an introduction to what's referred to as a corridor system or a channel system of monetary policy. Essentially, you're able to exert some kind of influence over the demand curve without really taking the supply curve into consideration. So this kind of system might be a little bit more appropriate now in an era of ample reserves. So essentially, what I want to do is I want to, in case people aren't sure exactly what a corridor system is, I'm going to give you a little brief crash course on this. So before the Great Reservation, we had, this is basically an Econ 101 here situation where, you've got specific types of overnight interest rates you want to peg or you want to manipulate. And we would do management of the supply curve. And that would come about either through an open market operation, if you wanted to do some kind of a permanent change in the supply, or you could do a reverse repurchase agreement where it might be something temporary, right? And we just, we want to lower the interest rate, you flood the market with credit, and the price of credit falls, and you have what you need, all right? And likewise, if there's been a demand curve shift, we can offset the resulting influence on interest rates by providing the credit to fill in the gap, so to speak. All right, but now when we kind of need a lot of reserves in the system and we can't, really bring the supply down enough if we need to lift off, for instance, if we want to increase our interest rates to, cool the economy off, we can't really do that with the traditional system. So we would use what's referred to as a corridor system. And you can see here that the demand curve for reserves is, same downward sloping, and the supply curve for reserves is also vertical as before. However, we have these upper and lower limits here, right? And the upper and lower limits are the result of these two facility interest rates here. So the standing facilities, one of them is something that we've had for a while. It's called the discount window. And that provides a pretty hard ceiling on the overnight interest rate. And the lower interest rate, referred to as the floor in a corridor situation, is the interest rate that is on the overnight reverse repurchase facility that's provided by the Federal Reserve as well. So you might ask yourself, well, why does the supply curve sort of kink like this, and why does the demand curve flatten out? It's an arbitrage argument where, for instance, if the federal funds rate were to fall below the overnight reverse repurchase agreement rate, a bank can essentially borrow money from the interbank market at a really, really low rate and then deposit it at the central bank at a higher rate and collect arbitrage profits, without any real constraint. So now if all the banks are doing that, that's going to drive the interbank market up because everyone's going to be borrowing from the interbank market to try to take advantage of this arbitrage opportunity. So you're going to end up seeing the interest rate in the interbank market start to rise until it meets the lower interest rate on the overnight reverse repurchase agreements. Now, there's a symmetric argument for why the ceiling cannot be surpassed, and that is if the interbank market rate were to go above the ceiling here, you can go to the Federal Reserve discount window, borrow as much as you want, and then supply it to the interbank market and also collect, infinite profits on the other end. And if everyone's doing this, what you'll see is that by flooding the market with credit to try to take advantage of this, the interbank market rate will start to fall until it meets this ceiling here. And so these two extremes here, the floor and the ceiling, provide kind of a sandwich, and you cannot really move the interbank market rate outside of that, outside of those limits. So here are a couple of situations where we can see here that the upper and lower limits, they're not binding at all. The supply curve shifts to the right or to the left, and the interbank market rate responds as usual. Here on the right, however, the floor is actually binding in what's referred to as a floor system. So here, the interbank market rate went fairly low, and we also need to, let's say, provide some kind of adequate credit availability because there could be a financial issue. We can see here that we can allow the supply of credit to move to the right, and it will not decrease the interest rate, okay? And so this is an example of what's referred to as a floor system. We could see something similar with the ceiling, right? Where here on the left, there's a non-binding discount rate or discount window rate. You can see we could raise and lower the discount window rate, but it has no bearing on the interbank interest rate here. However, on the right, we have this, the scenario where it actually is binding. If that interest rate is high enough and we want to lower the interest rate, again, without increasing the supply of credit, we could actually just lower this discount window rate, and it will push the overnight rate downwards, right? So that kind of just gives you an idea of what we're looking at. Here is, again, on the right, this is something that we've kind of experienced recently where we needed to have some level of liftoff off the zero lower bound without necessarily trying to really pull a lot of the credit out of the system, because that, again, we want to minimize the volatility as well. What the Fed can do then is increase the interest rate on the overnight facility or increase the interest paid on excess reserves, and that allows the interest rate in the interbank market to raise without really touching the supply curve at all. So I thought that with all of this policy here, this kind of motivation for this research was coming about kind of like a lack of a framework for really trying to understand how we're going to provide some kind of stabilization policy in an era or in a regime where there's so many reserves in the system. So that's kind of the motivation for this paper, really. And it's very preliminary, obviously. So I would really welcome you to take notes, and then if you can email me comments, that would be fantastic. So in terms of the research question for this paper, the research question I originally wanted to ask was, what I have here on the upper graph is the actual facility interest rates. The blue line is the discount window rate, and the red line is the overnight reverse repurchase agreement rate. And you can see that there's been an upward hike here in 2017 till 2019 up until COVID. And then we went back to the floor, and now we've been experiencing a hike in order to try to combat some of the inflation that we've seen come about as a result of, supply side issues. The question I wanted to ask, though, with this paper is, with a corridor system like this, you can not only increase the interest rate by shifting the entire corridor up, you can actually also adjust the width. And the economy will also respond to changes in the width of the corridor. And so the question I had was essentially, is the central bank here taking advantage of the ability to adjust the width of the corridor? Because you can see that the lower graph here shows you the spread between these two interest rates. And there hasn't been much activity when it comes to the spread in relation to the actual shifting of the entire corridor up and down. So this is what I'm trying to answer with this paper. The preliminary answer is there is a lot of extra volatility that can be actually addressed by adjusting the width of this corridor. So I'm going to go over the actual model with you, and so that hopefully you can understand why that's the case, right? So here, the main takeaway is that altering the spread of the facility rates in combination with the corridor target, it actually adds an additional dimension to monetary policy. And
Chris?
what I'm going to do is I'm going to actually include one rule. It's one Taylor rule for the corridor itself, and there's going to be a separate Taylor rule for the actual spread. So there's two Taylor rules that are going to address this, and that is kind of the research findings here. So are there
I
any
have a
questions
question
before I
from
move on?
Gustavo.
Yep.
Christopher, this is Gustavo from the bank. A question that I have is that what will be the basic trade-off here that the central bank will face? I mean, because I would presume that perhaps like the central bank doesn't use the width of the corridor in reality because there are some constraints or some good reasons for not using it. And it's not just that the central bank doesn't use it because it doesn't take that tool into account. I don't know if you get what I'm asking.
Yeah, so the overall answer to your question is I don't know. I think this is something in the conclusion that I allow that I think more research needs to be done, because you can also think that perhaps in this environment there's different types of approaches to monetary policy, and it could just be the fact that under the current circumstances, maybe it's not appropriate to adjust the width. All right, but I think the starting point is to actually see what happens when we do adjust the width of the corridor in relation to leaving it suppressed. And then we have like a counterfactual. Okay. And so from there, I think that would be something I need to follow up on with maybe another draft or a separate paper altogether to try to see, okay, well, maybe if we solve for the optimal monetary policy, which I haven't done in this paper, it could actually describe a situation where what the central bank is doing right now is actually correct. So I guess that was a pretty interesting dance around your question, but I really don't know yet. But this is something that's motivating me to really dig into this, really dig into the situation. So yeah,
Okay,
sorry I don't
thank
have
you.
a better answer for you, but
No,
it's
it's
something
okay.
I'm thinking
Thank
about
you.
right now.
Yeah,
So
sure.
any other questions? Okay, so let me go ahead and I guess give you a little bit of second level motivation for this. So during the Great Moderation, kind of the interbank interest rate was sort of what we understood as the sole interest rate in a lot of the new Keynesian literature that we've all learned in graduate school. So in that literature, pretty much like discount borrowing, interest rate on reserves, overnight repurchase agreement ward rates were really kind of deemed as second ordered. There was no real interest in actually understanding these. So the vast majority of the papers published using these types of models really ignored the discount window and really ignored the interest rate on reserves. Now, there's been a slight explosion in the literature with the interest rate on reserves. I think Peter Ireland and from Boston has a couple of papers on new Keynesian models with interest rate on reserves, but that is sort of not the focus of those papers. It's the focus of this paper is definitely on using the facility rates instead of just the targeting the interbank market rate as the only rate. So, this is kind of, and the other issue again, monetary aggregates. So like bank reserves have, not really been 100% ignored, but again, these things have been taking a sort of a second seat to just using, a single Taylor rule to adjust the risk-free interest rate. And that is essentially what drives policy in all these models here. So now, since we've got post QE, I think another motivation for this paper is, kind of a reexamination of the situation and maybe really reassessing the models that we're using to try to understand things. We use the new Keynesian model to really understand the benefits of discretionary policy with respect to commitment, even some kind of forward guidance. But I think the current regime in terms of the policy papers is kind of limited when trying to really understand what's called technical adjustments. And technical adjustments are those interest rate changes on the facility rates here. So the framework I'm going to use to really answer this question has a couple of new characteristics, and for the purposes of time savings, this is a very basic new Keynesian model. I'm going to go over the new parts of the model that you aren't familiar with, because I think everyone here understands how the basic new Keynesian model works. If not, feel free, I can explain the details away. But the framework I use is going to incorporate commercial banks freely lending and borrowing to each other in a perfectly competitive interbank market. And those commercial banks are going to be motivated to hold excess reserves with the central bank because they're going to face a random fluctuation in settlements, right, towards the end of the period. And again, this is borrowing from Poole's original paper back in 1968. And the commercial banks have access to those standing facilities, but in order to borrow from the discount window, those commercial banks will actually have to post collateral, right? And on the firm side, the banks are going to make loans to the firms in commercial credit markets, and a portion of these loans goes delinquent, and the commercial bank ends up just writing off these delinquencies. This is you can think of this as like a wealth shock in the literature that Yakov Yellow has written with respect to patient and inpatient borrowers and bankers. There's a shock like this with respect to some of the mortgages kind of, just disappearing. So I'm going to borrow a little bit of that mechanism there when I talk about creating a spread between the commercial lending rate and the risk-free deposit rate that has a result this results from having a portion of those loans go delinquent. So there's a natural spread that results from this. The type of monetary policy that's going to be implemented in this paper is, again, referred to as a corridor or a channel system of interest rate control. The central bank offers the lending facility, and this is what we refer to as the window, the discount window, and this is something that is set above the target rate. And there's also a deposit facility also offered concurrently, and this is something, the interest rate at the deposit facility is set below the target rate. So we refer to these as the ceiling and the floor, kind of informally, but those are the boundaries, and those are where we're going to try to keep the interbank market rate between, right? And so we're in this paper, I currently study what's called a symmetric corridor. So the essentially the overnight reverse repurchase rate is the target for the federal funds rate minus this spread term. So this is going to be lower than the targeted for the federal funds rate. And then the discount rate is going to be the target plus the exact spread. So this is what we refer to as a symmetric corridor, is that you've got the target for the interest rate, and then the floor and the ceiling rates are symmetrically distant from that interbank rate target. And I star is the target and S is a spread term. And we're going, like I mentioned earlier, I'm going to have separate rules for setting the target and a separate rule for setting the spread. So the economy is populated by households, banks, firms, and a government or a central bank. And in markets, we're going to be looking at asset markets, which include the deposit market, interbank market, and the lending market. Goods market is going to just be our typical, final good, firms facing monopolistic competition with sticky prices. And there's also a labor market here, but the labor market's perfectly competitive, right? There's market segmentation. I make that assumption so that households cannot lend directly to the firms. And there's a cost channel. Firms need to finance their wages before production occurs, right? And that creates what's called a wage in advance constraint. And there's a pretty good literature here that utilizes that in order to create what's called, or to study the cost channel of monetary policy directly. The interbank market's competitive. And again, there's an aftermarket payment shock. And if you find yourself without enough reserves to stay solvent, you have to go to the window and borrow the difference. And if you end up with an excess amount of reserves, you have the choice to park those excess reserves at the central bank and earn the floor rate. All right. And then this is something that has also been utilized in literature. A couple of these papers, if some of you are interested in those references, again, feel free to email me and I can email you a reference list. Again, I've already mentioned the final goods sold are in monopolistic competition, and it is that market's characterized with sticky prices. All right, so let me again go over the. Is that a question?
Yes, quickly. Yep. Could you go back one slide, please?
Of course.
This is Ernesto Pastel from the bank. Very quickly, hi. So the typical new Keynesian mechanism works that when there is a change in the monetary policy instrument, there is a change in labor supply.
That's right.
So here, since wages are paid in advance, how this setup affect the standard transmission mechanism of a standard monetary policy?
So I think in the standard case, and I've got an equation later on that should hopefully explain that. But what I'll do is I'll essentially give you the oversight here. In the standard literature, we see that when the firm solves its cost minimization problem, it chooses labor to solve that cost minimization problem. And then we end up solving for the marginal cost term, which is essentially the wage divided by the labor productivity term or the technology term. So if there's an increase in labor productivity, marginal costs fall, and we see that inflation tends to fall as well, right? So if there is an increase in wages, because let's say that the household decides to not supply as much labor, that also increases marginal cost and we see inflation rise. Now with the cost channel, what you end up having is that the marginal cost is actually equal to the gross interest rate on the commercial loan times the wage divided by the technology parameter. So if there's an increase in the commercial interest rate, that's going to add an increase in the marginal cost of firms. And you're going to end up seeing that firms are going to do the cost benefit analysis. So when they're minimizing their costs, they're going to choose less labor. So a higher interest rate on commercial loans, the intuition should be that that's going to lead to a lower demand in the labor market. And if households are fairly inelastic with their supply, what we should see is a decrease in the wage, right? So I think that's kind of the mechanism here, right?
Okay, so the change in the wage is a consequence of
yes.
Okay, thanks.
Sure, of course. These are all great questions. Any others? Okay, so the first key component, again, I'm going to talk about the interbank market. So the Bank J has the following balance sheet. It's essentially loans are the L represents the commercial loans at time period D from commercial bank J. The capital I refers to net interbank lending. So again, commercial banks are free to borrow and they're also free to lend, and it's perfectly competitive. You can think of it as almost like realistic, where it's anonymous, and it's net. So I'm taking the net amount here. So this can be both positive and negative. If the bank supplies, $100 million worth of reserves and they borrow $200 million worth of reserves, that I is going to be a negative 100, and vice versa. H is going to represent excess or precautionary reserve holdings, and the assets there have to be balanced by the liabilities, which include the household deposits here. So this is the basic balance sheet for a commercial bank in this marketplace here. The banks, again, can lend at competitive interbank market interest rate I, and like I've already alluded to, once that interbank market closes, these banks are going to experience a net payment shock. And so you can think of this as they're settling their reserve balances based on the real activity of the day. Okay, and so some banks might find themselves with a negative shock. Other banks might find themselves with a positive shock. So the shock here is essentially symbolized by this capital fee. And what I'm doing is here, I'm going to say that the shock, the repayment shock, is a proportion of the size of the deposit. So this is one way at getting if a bank decides to increase its deposit position so it becomes a bigger bank, the consequence of that, or one of the costs it needs to take into consideration when it raises deposits, is that the larger the bank becomes, the larger the resettlement shocks at the end of the period, right? And so to make this analysis pretty easy, I'm going to assume that that shock is uniformly distributed throughout these two extrema here, right? And that, there's a paper by Ashcroft in the Journal of Money, Credit, and Banking that kind of makes this assumption. That's more of an empirical paper than this is, so I kind of borrow that assumption behind the repayment shocks from that paper. Now, if I were to look at the data and we look, I'm not exactly sure the payment shocks are actually uniform. So I would, whatever inference I make and whatever inference you take from this presentation, take that assumption into consideration and normalize appropriately. So here, using the notation from the previous slide, if the excess reserve position is actually stripped away by the repayment shock, so that H minus phi is less than 0, then that commercial bank has to borrow the reserves from the central bank to meet that net payment outflow and stay solvent. On the other hand, if the excess reserve position is adequate so that it supersedes the payment shock, then the bank can earn interest on the net balances by depositing them at the central bank's facility, okay? So you can kind of start to see a little bit of a beautiful, sort of a beautiful kind of conflict here, because there's opportunity costs that show up, because the banks don't exactly know what their end of payment resettlement is going to look like. So if they're a little too, if they're a little too risk averse, then they're leaving money on the table, because those excess reserves, they could have lent them out into the interbank market, or they could have created commercial loans with those. And likewise, if the bank is a little bit too risk hungry, then they might not carry enough excess reserves, and now they have to face a higher penalty rate at the discount window to make up for it. So by adjusting the floor and the ceiling rate, what the central bank can do in a model like this is they can actually alter the perceived risk profile of the bank, because the opportunity costs change as a result of an altering of the landscape when it comes to the ceiling or the floor rate. And so that's kind of how the transmission is going to work in a model like this.
Christopher?
Yes.
This is Ernesto again. Sorry for interrupting.
No worries, Ernesto. No, of course.
How often do central banks use the reserve facility?
Yeah,
what I'm worried about is that it seems that insolvency is not a possibility for these banks.
Right.
And we know that there is this stigma of going and knock the door of the central bank.
I'm actually writing your question down, because that's pretty important. I never thought about that. So that's one thing I should probably look at as well, is to actually see how often do those banks tap those facilities. Now, I'm not actually sure I can actually find that data. Now, what the data that is available is I could actually find the volume of transactions that are occurring. That's publicly available data, but I'm not sure banks want people to know how often as much as we've tried to destigmatize visiting the facilities, I'm not exactly sure there's all the banks that are actually using them regularly want that information disclosed. I'm not exactly sure.
So let me ask you first a question. So
yeah.
Here, going to knocking the doors of the central bank is something that happened in equilibrium. It's going to happen in equilibrium, the model?
Yes.
So the model predicts that we should observe that going on in the data.
Yeah, that's right.
And I agree with you. I don't know about systematic information, but casual information from big crisis and narrative account big crisis. There are all these ideas that bank runs get triggered when people get to know that one bank went and knocked the door of the Fed.
Exactly.
Which prevent them to do so.
That's right. And it's one of the reasons why I think when we were in the financial crisis, the central bank actually didn't ask who wants who wants money, they basically gave everybody money, told them to shut up and take it. And it was like a kind of like a firing squad. You don't know who's got the bullet, you know what I mean? So it's kind of an interesting thing. I think one way I can kind of square this assumption is to say that I've got a lot of banks in the system. Some of them might take advantage of this. Some of them might be okay if they're very conservative. But if we're going to aggregate and create a representative bank, I would say perhaps they're in constant contact with the window, and that proportion of business that's done at the window can be said to be the proportion of banks that are constrained to actually have to participate. But I mean, I haven't really explicitly made that assumption, but that's a very, very important question. I appreciate it. Any others? Any other clarifications I can make?
I'm recording about the news that came about during the financial recession, and in order for the banks to have a stigma of using these facilities, information should be known. So I think, if I'm not mistaken, that information should be available. Otherwise, there would be no stigma.
Okay. I'll do some digging, and that's an interesting follow-up question. So which banks actually did use this? All right, this is good. Others? All right, I'll move on.
Sorry.
Yeah, you had another one. Okay. So again, in practice, the lending by the central bank at the discount window, like I said, is collateralized. You can go on to the Fed's website or and find out what types of assets are acceptable as collateral, and also what type of margin requirements based on how risky that asset is. So, you know, things like government debt tend to have a pretty high, tend to have a decent margin requirement versus something like a commercial and industrial loan. It might be a little bit riskier. So that is something I use to actually calibrate the parameters in the collateral constraint. But let me get to that. And then, you know, the other thing I can preface this with, so technically speaking, if you engage in a reverse repurchase agreement with the central bank, technically it is collateralized, because essentially if you have excess reserves and you want to park them at the reverse repurchase facility at the bank, they're going to give you bonds for those excess reserves with the agreement that they're going to buy them back from you at a higher rate. And whatever the percentage increase in the prices, that's essentially the floor rate. So I don't really collateralize the floor facility, because that can kind of be a little complicated, and I'm not sure the costs of the complication are going to outweigh the benefits of the extra explanatory power. So I only assume that the borrowing from the central bank is collateralized, right? And that is essentially what's going to lead to the real effects of adjusting the spread. Because if you've kind of been following me along, you could be asking yourself, well, if it's a symmetric corridor, and if the payment shock is uniform, then there should be no real effects. Whatever happened in the aggregate, the negative shocks offset the positive shocks, and the interbank market rate shouldn't move at all. So the way I kind of tip things so that real effects occur as a result of changing the facility is I allow the borrowing to be collateralized by loans, and the floor rate is uncollateralized. And so now when you adjust the spread, it actually will change the bank's behavior, right? So keep that in mind. That's an assumption that I make in this model to get things to actually move. So that's something that I think I add to the literature here, because the traditional analysis of the channel system, some of the other references I mentioned earlier, they actually ignore the collateral, right? Those papers aren't general equilibrium papers either, though, so they can get away with it while I cannot. So here, I mentioned this before, the central bank is going to be accepting the commercial loans that the commercial bank makes as the collateral. All right, so the banks essentially in this model are going to hold collateralizable assets and reserves to meet all the settlement flows that they face, right? And that's going to give rise to this collateral constraint, which I say that the excess reserves for Bank J and the collateralized loans that can be posted as collateral. When you add those two together, they have to be big enough to offset any flow shock that Bank J faces. And I'm sorry, there should be a J here under the deposits. I dropped the J. That's for specific Bank J. So this is the collateral constraint. And you can see how if the bank has a certain amount of loans that it could use as collateral, it might need to increase its reserve position, its precautionary reserve position, if the shock result has been positive and it's persistent, right? And again, here, this C with an L is the margin requirement on the loans, okay? So I mentioned this earlier and explained that since borrowing from the central bank is collateralized, while lending excess reserves is not, the changes to the corridor width actually end up having real effects here, right? Here's the bank's profit function. And so this is kind of how I stick everything together. So let me go over this thing, and I can hopefully promise you that the bark is a lot louder than the bite. So here you can see that the capital Pi is the profit of Bank J, and it's made up of the loans that Bank J makes. And this I with the superscript L is the interest rate on commercial loans. Now, the bank also have loans, and I mentioned some of those loans actually go delinquent, and the bank just essentially writes them off as the cost of doing business here, all right? So I know that's a little bit of a hefty assumption. I don't have any sort of endogenous destruction of credit here. Again, that would add a complication to the model that I didn't want to draw the focus away from policy into credit markets. But, you know, I'm working on another paper with a friend from graduate school where we're actually using something similar to this, but it's kind of frictions in the credit market. And so in that case, there are endogenous destruction of credit relationships. But for this model, kind of as a first paper, I didn't really want to complicate things unnecessarily. So I'm just going to assume that's a constant. It's a stochastic constant proportion of loans get just destroyed through this delinquency process. The data shows that's in the neighborhood of about 1% to 2%, right, of loans that are made, they just go bad. The D superscripted interest rate is the interest rate on deposits by the household. You can also assume that that's the risk-free interest rate in this economy. There's no bonds. Households intertemporally transfer their wealth using deposits. As I mentioned before, I, without any superscript, is the interbank market rate, and this is interbank market lending. So if this commercial bank here, J, finds itself with positive net interbank lending, it's going to earn interest on those loans. On the other hand, if Bank J needs to borrow money from the interbank market, then this is going to be negative, and this is actually going to show up as a cost, not as a revenue source. All right. Now, these two integrals here, these two integrals represent the payment shock at the end of the period, right? So here you can see that this is the PDF of that shock in both cases. And depending on the position of the commercial bank's excess reserves will determine whether or not the bank is going to have to park the money at the Federal Reserve or the central bank, or it's going to have to borrow the money from the Federal Reserve or the central bank here. So here you can see that the ranges on the integrand. Here, the shock is between the commercial bank's reserve position and the lowest value the shock can take. So in this case, the shock is such that there's adequate reserves to meet the payment flow, and the bank in this case will be sending that extra money to the to the central bank, and it's going to earn I star minus S on that excess reserves. On the other hand, here you can see that the payment shock falls above the excess reserve position of the bank, and it's going to have to actually borrow the difference there. And so depending on where H is in relation to these two extremes, will tell you what's likely to happen here in terms of the bank being a net borrower from the window of the central bank, or a net lender to the commercial bank. And by making changes to these interest rates here, it's going to impact the reserve position of the banks. And going back to the balance sheet, you can see that changes in the reserve position are going to alter the loans that the bank wants to make. And that's going to lead to real effects on the real side when it comes to production.
Hey, Chris.
Yes, Mario.
Regarding the profit function, shouldn't you also be assuming that the interest on the loans that went delinquent also don't get added to the profit? Because is my understanding of this is correct? You're saying that you might be getting some interest from those loans, but they also get delinquent.
Yeah, I mean, I could think it's like maybe they have to refinance their loans to better terms, something like this. So I don't know. I mean, yeah, that's a fair point. I should talk about this in the paper.
Yeah, so maybe adding IL delta LLT.
Yeah, that's right.
So
that's
it would
right.
be, so you wouldn't add some interest on the loans that went delinquent, something like
Yeah,
that.
because this is essentially decreasing the interest rate on commercial loans. Essentially, I think if you factor out the L, what you end up with is a lower interest rate. So
Yeah,
that's a good point, Mario. Thank you very much. So delinquencies should not earn interest. Okay. All right. So notwithstanding Mario's comment, these are the different characteristics and the different assets of this profit function that the commercial bank is going to be operating with. All right. And so the problem is the commercial bank is going to be maximizing this profit function subject to the balance sheet and the collateral constraint. So the way I solve this is I take the balance sheet over here. Let me go back to the balance sheet. And I solve the balance sheet for I, and I substitute it into the profit function of the commercial bank. And then I create the Lagrange multiplier chi, and that's going to be on the collateral constraint. And then we just take first order conditions to solve for the optimal choices of each commercial bank. And so when we're going to start with precautionary reserves as a fraction of deposits, what I end up with is I end up with a function that looks like this, which has some nice intuition. There's three components that we can witness here when it comes to the choice of excess reserves or precautionary reserves by the commercial bank. The first is there's a precautionary element, and that is the volatility of the payment shock, epsilon, relative to the spread S. The second component is there is an opportunity cost of inadequate reserves, meaning the difference between the target interest rate and the rate that is in the interbank market. So don't forget that the target rate here actually raises and lowers the entire corridor. So the floor or the ceiling actually is a function of the target rate. And then last but not least, having excess reserves actually relaxes the collateral constraint slightly. So that Lagrangian multiplier also shows up in this demand curve for excess reserves, which I think is kind of nice. When we look at the commercial loan supply, when I take the first order condition with respect to commercial lending, I end up with an optimality condition that looks like this. Now, on the left-hand side, we see that the marginal benefits of a extra commercial loan include the interest that the commercial loan earns and the sort of proportional relaxation of the collateral constraint. Because again, don't forget, the commercial bank here can use those commercial loans as collateral. So that actually shows up as a benefit. And so when a commercial bank in this model is actually contemplating whether or not to make a loan, it's not only taking into consideration the interest that it's going to earn on the commercial loan, that commercial bank is also taking into consideration that, if I make this commercial loan, I might need to use it as collateral in the future. So there's an added benefit to making commercial loans, and that is that it does relax the constraint. What's the marginal cost on the right-hand side? The costs are essentially that you're going to be giving up the opportunity to take that money and lend it in the interbank market. So you're giving up the ability to earn IT, and also like this delinquency rate shows up as well, and that is going to essentially show up as a cost here. Again, based on Mario's comment, what I'm looking at here right now is also if I subtract delta L from both sides, then I can see that the net benefit would be ITL minus the delinquency rate. You can think of it that way as well. So I think, Mario, your comment actually is making a lot more sense now that I'm looking at my slides. So I'm going to take that into consideration, definitely. I really appreciate that. And last but not least, a little bit more of a nastier equation is the optimal choice of deposits by the household. So this one, the intuition is a little bit more difficult to wrap our minds around. On the left-hand side, we have the costs, right? And the costs are, where are the costs? All right, it's the remuneration to the household, ID, but there's also, you know, unlike the other two, an increase in the deposits here actually will tighten the collateral constraint, because if you remember the assumption I made, the repayment shocks are a proportion of the deposits that the household, or I'm sorry, are the portion of the deposits that the central bank or the commercial bank holds. So the larger the deposits are, you know, the bigger the payment flows. So here on the other side, when a bank is deciding how much deposits to demand, it has to take into consideration, yeah, there's a benefit to this because I can create loans out of it. I can use it for precautionary reserves, but the more deposits I hold, the larger are going to be my repayment shocks at the end of the period. So that's going to show up as a marginal cost here. And the benefit is that I can take those deposits and create interbank loans with them. And I can also have it contribute to this term here, which essentially is related to the demand curve for excess reserves. And this is going to be a term which will allow us to kind of, you know, lessen the impact of the shock, right? And this functional form here is a direct consequence of the assumption that the repayment shocks are uniform. So turning to the firm issue, and this also goes back to Ernesto's question. So this is the equation that I was going to talk about. In the traditional New Keynesian model, you can see that marginal costs here are a function of the wages in the perfectly competitive labor market and labor productivity here. Now, if we incorporate the wage in advance constraint, we end up with marginal costs looking like this now. So you can see that if there's an increase in the commercial lending rate here, ITL, then either you're going to have to holding fee constant and Z constant, the wage is going to have to fall, or the other way around, if we have wages already set, you know, the marginal cost is going to end up having to rise. So this is something that shows up in a lot of these papers that deal with incorporating a cost channel of monetary policy when it comes to having to pay your wages in advance of production. All right. And again, here, I with a superscript L is the commercial lending rate. All right. Okay, so let's talk about policy, and this is going to close out the model. So this is going to be technical adjustments and changes to the interest rates of the standing facility, and we're going to be looking at a Taylor rule for I star and a Taylor rule for the width S. So, you know, here, just as a recall, don't forget that the discount rate is this I star plus S, and the overnight reverse repo rate is I star minus S. And so we're going to try to set those in response to a basic Taylor rule that responds to inflation, all right? And so there's three different variations of this policy regime that I test in this paper. One is we're going to set I star according to a Taylor rule that responds to inflation, and then I'm going to ignore changes to S. So I'm going to leave S constant. So this is one extreme. The other extreme is I'm going to set S, the width of the corridor, using a Taylor rule, and then I'm going to allow the target to remain suppressed. So that's the opposite extreme. And then the third policy regime that I sort of simulate here is both I star and S according to the independent Taylor rules, and they're both responding to inflation. So they're independent rules of each other, but they're both, you know, I mean, independent insofar as, you know, not, you know, they're both responding to inflation. So they're not technically 100% independent. They're both responding to the same variable, but they're separate equations. So here you can think of changes in the corridor. You can have that corridor rise and fall, but as it rises and falls, maybe it becomes thinner or thicker. Okay, so that's kind of the picture you might want to have in your head. What do these Taylor rules look like? So again, these are not linearized. These are nonlinear. And so we've got the first set where I'm going to actually choose I star and suppress S that's going to be I star, and there's going to be a little bit of inertia here. And you can see that this is also going to have into consideration I star T minus 1. And rho I is the persistence parameter on that. And then here is the inflation rate that this rule is responding to. So phi pi is the degree of response to inflation that the central bank's going to alter the height, or, it's going to increase or decrease the entire corridor. Again, here S is just going to be remaining suppressed. So you can either set S to a constant. Here I just let it be a process that doesn't respond to any shocks. The opposite case is essentially we're going to move the response of inflation down to the corridor width. We're going to allow I star to remain unchanged, and we're going to adjust the width here. And then the third situation, yep, question.
May I ask something very, very quickly? Is that if there is no sticky prices, does S still going to have an effect? And actually I still going to have a real effect?
Yes. And the reason I know that is because before I wrote this model up with a new Keynesian framework, I used the same model under flexible prices, and you end up with a similar situation. Again, this is because of the assumption I've made when it comes to collateralized borrowing. So you're going to have real effects show up here because when the central bank changes the interest rate at the discount window or changes the interest rate on the floor, that's going to alter the position or the portfolio of the commercial bank when it comes to how many excess reserves do I hold in relation to the commercial loans that I make. So you're going to have a change in the real side just through the fact that the bank is going to alter its portfolio in relation to the change in the corridor. All right, I hope does that make sense, Ernesto?
Yes. So another question related to that. So basically, I'm trying to think about what is the right benchmark to think about. What is the objective of the policy here?
Okay.
So is there a divine coincidence?
I'm not. I don't know. I don't know the answer to that question. Like I said, this is really still fresh in my mind.
Okay.
So,
and can you repeat, please, what if you keep S I constant? What is the effect of S?
Yeah. So if I keep I constant, then what I'm essentially saying is because again, when I change S, I'm altering both the floor rate and the discount rate together at the same time. And if I, for example, if I increase S, I'm going to be lowering the discount window rate. So it's going to be cheaper for the central bank to borrow, for the commercial bank to borrow from the central bank. But I'm also increasing the floor rate. So there's an increase in the opportunity cost of not parking your funds at the central bank as well. Now, the reason why I end up with real effects was going back to this really big assumption I made with respect to collateralized borrowing. Okay. So you're going to still see effects that come from a change in the width only because I assume that the banks have to collateralize their borrowing when they go to the central bank to borrow from the discount window. Okay, so you can think of an increase in S is actually going to be contractionary, and a decrease in S is actually going to be stimulative. I think I have that. It's either that or the other way around. I think I think I got it right. So if you have an increase in the discount window rate, so you could think of it in terms of 1/2 of that. So let's just concentrate on the discount window. If there's going to be an increase in the interest rate there, you can see that a bank might want to hold a little bit more excess reserves because there's an equal probability that they're going to be on one side or the other of that repayment shock. Okay. And so, especially if they're going to have to post collateral, that is going to be a little bit contractionary. So there are real effects on either side of this. So we don't have to just change the Taylor rule. We can leave the Taylor rule, or I'm sorry, I star. We can leave I star as it is, and we can still manage to provide stabilization for this economy And funny enough, another thing that I'm not exactly sure of the answer to is this whole Taylor principle of having to respond more than 1-for-1 with respect to inflation. For some reason that I'm not exactly sure of, I can set phi pi, these parameters here on inflation, I can set them to a number that's less than 1, and the economy still exhibits a rational expectations equilibrium. So I think this might be, if I'm targeting the...
With S constant, or
Yes,
allowing S to move?
in both cases.
Both
in
cases?
The simulation
Okay,
exercises I have.
That's strange.
In the simulation sorry, Ernesto, go ahead.
Yeah, I mean, if S is constant, I may imagine a mechanism in which you get the eigenvalues right, even if the Taylor rule doesn't satisfy the Taylor principle. But if S is if S is moving, if S is constant, not sure.
Yeah, so I think it's because most of the Taylor rule literature that we're used to is targeting the risk-free rate directly. So I think by targeting the interbank rate, which is a little bit more realistic in terms of what really happens in the marketplace, and I need to really understand, I think, the relationship between the interbank interest rate and the deposit rate, because the deposit rate, I think, still satisfies the Taylor principle. It's just that we're satisfying it through the interbank rate, and there's something going on between the interbank rate and what the interest rate that the households earn that still allows a model like this to satisfy the Taylor principle, perfectly. So it's just an interesting characteristic of it. But
okay. But
your question
anyway,
with respect to
going back to Gustavo's question at the beginning about trade-offs. So if S increases, then is contractionary, and what happened to inflation? It goes down or goes up?
You should start to see it fall.
Okay.
If I just simply do an exercise where so I don't do that in this paper, but if I do like a monetary policy shock, just without any technology moving or without any delinquencies, if I just do a monetary policy shock, I should see definitely a response to inflation. Where if I widen the corridor, it should be contractionary, and you're going to see inflation fall.
Inflation fall. Okay. So in that sense, it's a substitute of the standard monetary policy.
I believe
in terms of trade-offs. So divine coincidence should, some version of divine coincidence should apply.
All right, I'm making note of that, Ernesto. I'll have to revisit this. Okay. All right, let me go onward into this and show you the simulations. So with the simulations, I really want to concentrate here on is the window that displays inflation. So this scenario here is there's going to be a delinquency shock, so an increase in the rate of delinquencies on commercial loans, and we're going to set I star, and S is going to be suppressed. So this is sort of like more conventional. We're not really using the width of the corridor at all. We're just going to increase or decrease the corridor. And what I have here is that there is going to be the temporary increase is going to be a magnitude of 1% here. And the red squares are a response to inflation of 0.25. The blue triangles are 0.75, and the green diamonds are 1.25. And you can see here, obviously, as the response to inflation increases, you get a little bit less of a volatility here. So delinquency rates go up. The mechanism here is that delinquency rates rise. That increases the marginal cost of commercial lending. So that IL increases because the spread goes up. That increases the marginal cost for firms. And then that's passed on through the Phillips curve into heightened inflation. So you might be asking yourself, why would there be an increase in inflation when there's a decrease in, if there's going to be an increase in delinquency? It's because of the extra increase in marginal cost facing the firms that ends up just getting passed onto the marketplace in the form of higher prices through that increase in marginal cost here. All right. Now we're looking here at the other scenario where if we set S and now we leave I suppressed, and we got something that looks very, very similar here in terms of magnitude. All right. Now the change, so I'm going to go, if I set I star, you can see with the same shock, we have an increase of inflation of about 0.25%. And when we're stabilizing the economy with the width of the corridor, we still get an increase in inflation, but it's not, it's a little bit more volatile. It goes upwards of about, 0.33% here in this case, okay? So while we still can provide some kind of stabilization, it's not as effective as the interest rate target itself, right? So the width can be used to stabilize, but it's not as effective as I star. Now, the biggie here is when I set both of them. Now, if I set both of them in the same relation, you can see that the response of inflation is about 1/2 here. And again, if we were to set the Taylor rules to respond to some other variable, you would probably see the same level of suppression in some other variable. So if it was output and inflation, we would probably see output respond a lot more than it is right now. Okay. Now, so that is for the delinquency shock. Now, when we turn to sorry, I forgot to copy this wrong. So this is actually here. This is going to be a technology shock here. This should not be delinquency. It should say technology up here. All right. So combating the shock to technology here, we can see that increases inflation to 0.16. If we're responding with this magnitude here, 0.25 in the parameter on the Taylor rule. And obviously, as we have a greater sensitivity to inflation, you're going to see a little bit more of a suppression in the response of inflation. And again, when we go to the spread, I'm sorry, here. So this is the technology shock. So take everything I said and apply it to this picture here. You can see that the increase in technology decreases the marginal costs, and we end up with a decrease in inflation. So this inflation falls to about 1/3 here, all right? Now, if we stabilize using the width, we can see that it doesn't stabilize as well. It goes down to almost about 0.4% interest rate in the larger case here when we're not really responding to inflation. However, if we use both I star and S with independent Taylor rules, we can see that the response of inflation is about 1/2, okay? And that is kind of the real takeaway here on this paper here, is that just looking at a situation where we are stabilizing the economy with just using I star and just using S, we get policy responses, but I think there's a lot of benefit for the central bank to really consider perhaps augmenting its policy tools with not just changes to the federal funds rate, but also altering the width just as frequently, because there could be benefits that could be experienced by that. So the conclusion here is the spread of the corridor may be underutilized. Again, I'm not exactly sure of what optimal policy looks like using this model. If I solve for an optimal policy, it might be the case. I think, Ernesto, you mentioned this earlier, or one of your questions, and that is that perhaps, the central bank actually is doing what's correct given the current situation. That's this point here. There's a non-trivial probability that perhaps in the current environment, it makes more sense to only adjust the position of the corridor instead of the width. So maybe the spread actually isn't underutilized after all. And so more research is required here. And that concludes the slideshow. So I'd be happy to answer any questions, but I really, 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 really appreciate your attention. And definitely the questions are very, very good. And I know for sure it's going to improve the paper.
Hey, Chris, I noticed that when you make the presentation of the results, you focus mainly on inflation.
Yes.
What happens to output? And what I'm thinking of, does this make a change in the sacrifice ratio, like using both the spread and the Taylor rule decreases the sacrifice ratio? How much output do you need to lose in order to decrease inflation? Is there like...
Yeah, so here, I'm looking at the slide here. So right here with output. So this is just if we set I and we leave S suppressed, we kind of see that there's a decrease. We see that there's a little bit of a decrease here, and it goes down to about maybe 0.9%. And then with the S stabilization, it's about the same for all scenarios here. But when we use both of them, it seems that there's a little bit more of a sacrifice there. So there is a trade-off, I think, here, as there should be. I mean, how are you going to get inflation more under control unless we do have to sacrifice a little bit of, we have to break some eggs, so to speak.
No, maybe this policy was allowing us to reduce the number of eggs that we need to break.
I see. That's another question I should look at, is the ratio, then the sacrifice ratio. Because if there's a sacrifice ratio that's favorable, I think that's a better result, maybe.
So does anybody else have any other question? I would like to thank Chris for presenting his paper. I think it was awesome. And also for everyone for attending.
Yes, thank you very much, everybody. I really, really appreciate it. And hopefully I get to see you all again someday.
Okay. Thank you very much for everyone.